Did you know Montel uses artificial intelligence and machine learning to forecast spot prices, inflow to reservoirs, wind and run-of-river production? We can improve forecast for your individual power plants anywhere in Europe. Contact us at ai@montelnews.com for more info.
Hello listeners, and welcome to the Montel Weekly Podcast, bringing you energy matters in an informal setting. This week's topic is gas. The past few days have been very turbulent, to say the least. Prices on all hubs, but on the Dutch TTF in particular, crashed, then rebounded, before plunging again. Joining me, Richard Sverrisson, to talk us through current market dynamics and to help us gain some understanding of why participants are so jumpy at the moment is James Waddell, gas analyst at Energy Aspects. Listeners, we recorded the initial podcast actually as prices were crashing. But I was very lucky to get hold of James and ask him what his views were on the reasons for the fall in prices. So James, please tell us what happened this morning as we were recording the initial podcast.
Thank you, Richard. Thanks for having me back on. Yes, it's very difficult to take your eyes off this market at the moment, even to record a podcast. What seems to have happened is a statement was issued by Gazprom on its Telegram messaging platform, where it talks mostly about what it's been doing on the operational performance of NS1 over the course of this year. And at the very bottom of that post, it talks about a 5.6 BCM of gas that it says can be delivered to the European market this year. Now, this is a volume that is probably quite a lot higher than the general market consensus. It's certainly higher than what we had expected in our balances for this year. And it indicates really just an earlier startup of those Russian flows than people were expecting. And as we discussed a little bit earlier, the Russian flows are really the key to when we might start to see the TTF relaxing back through a bunch of different coal to gas fuel switch triggers. Now, we look at this statement and the interesting way in which it was delivered with a little bit of skepticism in terms of what it means for actual flows this year. What we see as the main delay on those flows is the regulatory approval by the German energy regulator BNetzA in giving and issuing Gazprom an operator license. And we think that process could really drag on until late December, which would only allow for a very small margin of time over this year for them to actually deliver that gas into the European market. And that's how we arrive at that, our estimate about 1.5 BCM being delivered. Getting to this 5.6, technically we think Gazprom does have the upstream capacity to do so. We think it also has the pipeline capacity to flow that. We know for sure that the first leg of the pipeline was completed on the 11th of June. And, even giving 2 to 3 months for safety and integrity testing, that should be ready to start flowing ahead of Q4. And if that is flowing at capacity over Q4, well, that's 7 BCM that can be delivered into the European market. So it's a big risk-off event with people thinking that that could be the volume of gas coming into Europe. But as I said, it will require that regulatory approval from BNetzA for them to start flowing. And there is some talk in the market about whether BNetzA might grant some kind of provisional license to allow first flows. But again, we're a bit skeptical that that will be the case. And even if there is this drive within Europe to try and unlock, from some in Europe to try and unlock higher flows from NS2 to bring down some of these gas prices, to bring down some of these power prices, we still think the process will likely last into December.
Thank you very much, James, for explaining why the market is so nervous at the moment. Who knows what the coming days will bring? And listeners, here's the conversation we recorded with James on Thursday morning. We're recording this on a Thursday. On Wednesday, prices took quite a tumble, though they rebounded later in the session. What was all that about, James?
The events of Wednesday were quite particular. Very interesting crash in the market, a huge recovery. We lost about €5 on the initial crash, and then we recovered most of that by the market close. It was a lot of data being published by Gasgate indicating a potential startup for Nord Stream 2, which would have been well ahead of what most people were expecting in terms of first flows through that pipeline. And it really indicates the extent to which Gazprom really holds the keys to the price drivers at the moment on the TTF. A lot of people are watching what's happening with Russian flows. We've also had a bunch of outages recently on Polish transit, a lot of questions about when will Nord Stream 2 come online, and questions about Russia's ability to deliver gas into the European market. So all of this is mixed together. When the market saw that actually these data about first flows were not actually correct, the market quickly rebounded again. And now we're back into a situation where we're back at TTF prices being near their historic highs, so they're not as high as earlier on in the month. And that is just a symbol of how tight we are in the European market, how much we're having to price gas out of the power sector in order to shore up the storage inventories ahead of this winter.
We'll come back to some of these issues. Just to say, for maybe those listeners who aren't familiar with Gascade, that's the German gas TSO, right?
That's right, yeah.
If we compare last year to this, we've mentioned it before on the pod in terms of the gas market. I mean, chalk and cheese. We saw last summer prices fall to about €2, and now they almost hit 50. Could you talk us through the journey and the main reasons for these very high prices?
Of course. So last year we had obviously the demand destruction associated with COVID and the pandemic, and really it was a situation where we had too much baseload supply being fed into the European market, and the pricing signals were really trying to deter as much of that supply coming in. So you're looking at your highest priced delivery sources being things like the oil indexed gas from Algeria or from Russia, and trying to turn that away first. And then moving on to the stage where you were sort of shutting off imports from Norway, and also LNG being shipped across the Atlantic from the US as one of the price signals. So we got down to this pricing point where we really just couldn't take as much gas, and we were having to price that off because demand was just so low. Fast forward to this year, and we've had a period where the LNG coming out of the US was heavily restricted over last winter. We had quite cold weather because of course, Northeast Asia, also in Europe, which led to a lot of LNG being sucked out of Europe over the winter. So that drove down our storage inventories in Europe. And then we got into the start of summer where we had fairly low inventories. And then we had a couple of very cold shoulder months in April and May, which stopped us from being able to build up those stocks. So when you compare stock levels to what was a previous tight year of 2018, just after the Beast from the East phenomenon, when we had very cold weather over February and March, we actually are riding on lower storage inventories right now than we were back then. We're about 5 BCM down compared to that 2018 minimum. And because of that low storage, we are having to scramble to try and price on as much supply as possible, in complete contrast to last year. So we've unlocked a lot of flexible output from Norway, from the Oseberg and the Troll field. We've unlocked a lot of extra gas coming in from Algeria. We're trying to price on gas coming from Russia, but Russia seems to be constrained in that it's not willing to use the interruptible capacity that's being offered through Ukraine to boost flows into Europe. So we still have quite a low level of Russian flows into that market. And the only mechanism that Europe is really finding to get some gas into storage is by pricing gas out of the power sector. So we're seeing now quite a substantial switch away from gas and towards coal in the market. And particularly that's visible in the last 2 or 3 months, where we've seen a big switch within the thermal stack towards coal-fired generation away from gas.
And in which country particularly is that the case? Is that maybe in Germany, Netherlands?
Exactly. We see that in parts
of Southern Eastern Europe.
In that northwest European space, to some extent, that's in Italy as well. But Germany and Netherlands are the two big markets where you expect to see the most switching potential.
No, we've seen the noises coming out of Germany that emissions this year are likely to be very high, which is also very interesting given that the carbon price has hit record highs again, or hit highs earlier this summer at about €58. So where is the demand for gas coming from then amongst these very high carbon prices, James? And what's the outlook going forward? When would you expect the switch back to gas, or what would trigger that?
So the demand is coming from just the recovery in both Europe and in Asia. I think we have to remember that going back to the start of this year, a lot of analysts looking at this market would have said that lots of LNG will come in and replace essentially what was going to be quite low Russian flows into the European market. And we haven't seen that. We're going to end up this summer with effectively LNG imports into Europe being down on year, despite the fact that last year we had a very low base on the amount of hurricane disruption we saw in the US. So we're actually getting very minimal LNG coming into European space because it's all going over to Asian markets amid a recovery in demand over in that part of the world. And then in Europe, you've got this recovery in demand just on the industrial side in terms of, and also on the commercial side. More things are opening up after a lot of the demand destruction we saw, most particularly in Q2 2020. So a big increase on that low baseline. And you're also seeing, we saw at the start of this summer, quite a lot of extra demand just because it was a very cold shoulder season. So that really boosted demand in Q2, year on year.
And you mentioned Asia. What are your expectations here? Will Asian LNG demand, will it subside over the autumn, or what do you think here? There's obviously a key factor in terms of, potential energy vessels coming to Europe.
Well, exactly. So one of the interesting things, and a lot of people are now looking into the extent to which these high prices will start to push gas out of the Asian market and maybe force elements like gas to liquid switching in the Asian power sector. But at the base of it, you've just got strong industrial demand recovery. You've had a hot summer in Asia, which has been driving things up. And then fast forward into the winter months, where you've got a lot of extra Chinese import capacity that's been brought online this year to really debottleneck that LNG flow into the Chinese market. And you've got these baseline increases in structural demand. You're looking at the Indian market, for example, with more fertilizer plants being hooked onto the grid and more city gas demand growth, more connections effectively onto the grid. So there's these underlying growth tendencies. Now, what we've been seeing as a headwind against that growth is the recovery in nuclear availability in both Korea and particularly in Japan. And this is one of the things that we expect to help loosen up that Asian market over the winter months and allow Europe to have more LNG coming into the European market on a year-on-year basis over the winter months. So we do expect to see some sequential easing from the current situation where really most of the LNG is ending up in Asia. And
how about Latin America? I've heard talk about that demand is quite strong there as well.
So one of the big drivers with Latin America has just been the state of Brazil's hydro reserves. It's been an extended drought, and that has been really picking up its demand for LNG cargoes going into that country. We've also seen strong growth outside of Brazil in the rest of Latin America, but really it's that Brazilian market which has been the standout taker for LNG cargoes.
It's quite fascinating when we're talking about European gas markets. We need to look at Brazilian hydro levels and Japanese nuclear. This shows how global this market is, James.
Exactly. I think having good LNG numbers feeding into Europe is very important for how we think about where the TTF is going to end up and what type of storage carrot we're going to get in Europe. And not even just in terms of the global sort of demand of outside of Europe, but you're also looking at these comparative markets, looking at what's happening in coal and looking at what's happening in emissions. Because I think one of the things that can be forgotten is that we've had a big increase in terms of relative prices, in terms of how tight the European balance has been, and therefore how much we've had to price gas out of power. But to price gas out of power this year, we've actually had to move to very high levels because those coal to gas fuel switching prices have risen a huge amount year on year. In fact, if you look at the TTF and how much it's increased year on year, about 65% of that gain has been just the gain in relative prices because coal has gone up, because emissions have gone up. And you can look also at the tightness in the global coal market at the moment as one of the key drivers for where TTF prices are going. And it's the extent to which China has refused to take Australian coal and really locked that Australian coal in, and is instead taking a lot of coal out of the Atlantic basin, which is leaving Europe short. So you've got these twin markets working in tandem to drive up the TTF.
And also, very strong carbon prices as well, although they seem to be coming off a bit this week as well. Let's talk a little bit about supply, James. Now, to what extent is Europe more dependent on Russia for supply due to LNG being redirected to Asia? I mean, you touched on it earlier.
At the moment, we've got Russia as the only flexible source of an increase in gas supply into Europe. So in terms of being able to bring the TTF back down, all eyes are on Russia. And that's why we saw that crash that took place on Wednesday. A lot of analysts are trying to figure out when we will actually start to see those first flows through NS2. And on the physical side, that is being completed likely by the end of this month. But in terms of unlocking those flows, we do expect that we need to get an operator license being given to NS2 to operate by Benetza. And without that in place, we don't think we're going to get first flows. So that's probably putting the startup timing into December. We actually learned a couple of weeks ago that the initial window for Benetza to consider NS2 as an operator company only really started when they've considered all the documents to be received, and they hadn't considered that at the start of August. That really puts out the first flows as potentially taking place in mid-December and potentially into Q1. And if we don't have those flows in place, then we're going to be going into Q4 with still very restricted Russian flows coming into the European market and a very tight situation. If we were to get Russia increasing flows quickly in Q4, and for some reason we get an early operator license being given to NS2, that would help to soften the market further and particularly going out into next year. And that's why we can see such a steep backwardation going from this winter into summer 22, just because most of the market largely feels that Russian flows will be unlocked. They will no longer be constrained, and we will have really Russia being able to deliver as much as it wants into the European market next year.
So, James, would you concur with the market here that prices will fall to euro 20, 25 euros once Nord Stream 2 comes online?
We do think that when Gazprom no longer feels that it is constrained in exporting gas to Europe, it should be able to deliver enough gas into the European market that we'll be able to almost fully maximize this reverse on the coal to gas switch and really get gas back into power in a substantial way, which allow gas to fall back through those coal to gas switching ranges and down into the low 20s for 2022. So we do agree with the market that is the single key that will unlock lower prices than we're seeing at the moment. Now, in terms of the timing, as we said, we think we're going to see the first NS2 flows basically taking place in December. That will still leave a very tight picture going into Q1 because, over Q4, year on year, you're having less capacity that's available via Ukraine because there's been a decrease year on year in terms of that transit capacity. So we could end up, particularly if it's very cold over Q4, burning through some of those already very low storage inventories. And it will take time for that increase in Russian flows to really translate into softening the TTF market over the course of next year. But by the time we get into Q2 and Q3 next year, there should be enough spare capacity for Gazprom to deliver into the European market that we can see a big relaxation in prices.
So big relaxation meaning what, James? We're not down to 2, surely, but 2 euros.
No, well, I think last year we did get down to that sort of single-digit number. Now, because of this increase in coal prices and in emissions prices on a year-on-year basis, we don't think that's really possible because when you're maximizing that coal to gas switch, you're looking at a price which is around the low 20s rather than last year when that was low 10s or into the single digits. And because of what's going on in terms of the Europeans' emissions targets and everything connected with the Green Deal, with Fit for 55, there is just this long-term bullish picture on emissions prices. So there's no likely event that's going to bring that market coming crashing down. And as I said, with coal prices, we're seeing a fairly slow response to these very high prices for coal, both in Asia and in Europe. And if there isn't enough supply unlocked in the coal market, those prices are going to stay very high for several months and certainly through next winter and potentially into next summer. So that just sets a very high baseline. And we don't think that Gazprom would want to deliver so much gas into the European market that it would more than crash the TTF beyond this coal to gas fuel switch and bring it down to ranges where you're shutting off supply from competing producers. Because if Gazprom wanted to deliver so much gas into the European space that it did that, the European market could crash as low as the price where you need to shut off US LNG coming in, and that's around 10 euros. So in terms of what Gazprom receives under a lot of its contracts, which are predominantly sort of TTF or hub index these days, that would be a major cut to the amount it gets per unit of gas if it managed to crash the market that much.
So it seems that Gazprom holds all the cards here. If I could just go back to Nord Stream 2, James, and ask you, because we're hearing 23rd of August, or certainly by the end of August, the actual physical pipe will be in place and will be finished. But as you highlighted, the permitting process could take several months. But there's also the small matter of the German election coming up, or rather a large matter, which is there a danger that it could be delayed even more, or that even it won't deliver gas at all if you get a Green Chancellor?
There are definitely these risks. We think it's an outside risk if the Green Party enters the governing coalition that we get any form of cancellation on the project. At the moment, it's in the hands of the German energy regulator, BNetzA. This is meant to be an independent body certifying the operational license. Now, if there is a political decision taken outside of that to try and stop NS2 flows, that would be another situation, but we think that's a fairly unlikely situation to actually manifest. We think as long as you have constellation in the German election where it's the Green Party and potentially CDU and a few other parties, there was no big risk to this project being cancelled, and there shouldn't be that much of a risk in terms of delaying the process because, as I said, it should be BNetzA taking this decision according to its own timelines. There is also a call within this decision-making process on the European Commission. But what we're seeing at the moment with these very high gas prices, which translates into very high power prices, is that increasingly states are coming to the Commission and saying we need to have some controls on how high these prices are going. We had this from the Spanish not that long ago. And if the Commission is seen to be delaying the process of unlocking NS2 and thereby forcing prices to continue to rise, that would probably not go down well with member states and not look good for the Commission. So I think there may be some urgency in actually signing off on allowing some of these flows to come through. So actually almost the flip side argument for delaying the project.
No, that's interesting, just to allow prices to ease under certain political pressure, as you mentioned, from Spain, but also certainly from other member states. But, it's interesting because how a potentially Green Chancellor will sell this to the electorate, because she's been a vocal opponent of Nord Stream 2. So it'd be interesting to see how this pans out. And obviously we won't get more clarity until maybe September, October, when we can invite you back, James. But what's happening in Eastern Europe? There's been, about Gazprom not booking capacity. As you mentioned, the flows through Yamal came down quite substantially a few weeks ago. Will Gazprom, in your opinion, take monthly or short-term capacity through Poland?
So this is all very sort of interconnected in terms of questions about Russia's ability to supply to the European market at present and whether it will have that ability restored going into Q4. The Polish route for Russian gas does look like the route most likely to be diminished in flows as you get Nord Stream 2 starting up. The main reason is because with Ukrainian capacity, that's now a sunk cost for Gazprom. It's been locked until the end of 2024 under the transit agreement that negotiated with the help of Germany and Europe. Poland will become a variable cost for Gazprom, and it will be, as it launches NS2, it will be thinking about how much you want to send through Poland. And therefore, that might have been one of the reasons and one of the factors why we didn't get a quarterly booking for Q4 and for the rest of the coming gas year on that Polish route, because Gazprom effectively wants to modulate on a monthly basis how much is flowing through. But with these prices and TTF up in the mid-40s, the actual booking costs for delaying booking until monthly or even shorter term capacity are not that significant relative to how much Gazprom is actually making in terms of sales into the European market. So we do think it does want to preserve a bit of that flexibility. In terms of whether it's able to deliver is the other big question, because obviously we've had this flow drop through Poland since the 31st of July. And I think it's important to stress that there was an initial flow drop before we got news of this fire on a facility linked to the Nowy Orungoy condensate processing and stabilization facility. There was a drop of around 30 MCM per day on the 31st of July through to the 4th of August. Now, this lines up a little bit with what we saw in terms of some news reports from Russia, that there was a fire on a major transmission line near the city of Perm in Russia, which may have caused a bit of a reconfiguration in flows and may have been part of the reason why we saw a bit of this flow drop through Yamal Europe. Now, this is something that we think could be fixed in the space of a month and actually allow a bit of a flow recovery in the second half of August. So that's one potential event which is separate to what has been going on in the condensate processing facilities near Uruguay. Now, regarding those facilities, there is a major processing stabilization plant in Novi Uruguay. The fire actually took place, we believe, at a facility which is about 12 kilometers away, which is a de-ethanization facility handling some of the gas coming out of the Uruguay field, but by no means most of it. And specifically, that fire seems to have affected only 50% of that de-ethanization plant's processing capacity. And even beyond that, we think it may not have been on the actual condensate splitting element itself, but more on the generators that are connected to that. So we think that you can return that 50% of that facility's capacity, which would restore about 13 MCM per day pretty quickly, at least by the end of this month. And then the remaining bit of that facility could be replaced over the course of September and potentially into October. So we don't think the impact of that is as grave as a lot of the market was perceiving it when we first started seeing these flow drops and this news of the fire.
So you expect in the short term then prices to ease substantially?
We still have a problem in that we just have very low storage in Europe. And we have some other disruptions at the moment in terms of Algerian supply coming into Southern Europe. And because we've already seen this flow drop into the European market, we've just cut more into the amount of gas that we're putting into storage. And because of that, we're just aiming for a very low storage carryout by the end of October. And this is the sort of situation where in a particularly cold year, we would not be able to get through winter on some of these storage assets. So the market is still fundamentally extremely tight. And we've been moving very close to the point where you are really trying to maximize that gas displacement from the power sector. And we feel that the market should really be around that level. So there's not a great extent to which we would expect the market to be loosening on this, just because it's already tight. It's already a scramble to try and get gas into storage by the end of October. And we don't have very much time left. And if we don't build up those inventories to a decent level, then this winter we have lots of upside risk on the TTF, because if we get a particularly cold winter and we get into February, March, and we get another beast from the east scenario, we will be scrambling and really competing against Asia as to who can price the other out of the market.
So by November, what kind of levels do you expect the stocks to be at? And is there any kind of regional difference here or variety in the storage capacity? One
of the key questions really is how low we expect storage at the end of October to be, because we've had this baseline of about from 2016 through to 2020, the lowest storage inventories was really 90 BCM. And that was at the end of October 2018, when you'd had this scramble to get gas into storage after the beast from the east the previous winter. And that was really a low baseline. And we're looking like we're going to be around about 5 BCM below that level going into October this year. It just doesn't look like we have the means to unlock more supply into the European market or to reduce power sector gas demand much further to get to a much higher level of storage carryout. So that sets up a winter where there's lots of upside risk on prices because you just have potentially very little gas in storage. Going into the last winter, we had around 100 BCM of gas in storage. And when we had Asia drawing a lot on Europe's LNG supply and diverting those cargoes from the Atlantic Basin into the Asian market, the TTF did rise a little bit, but it was able to be fairly moderate just because it could ride down on those storage assets. If we had a similar phenomenon going on this winter, we have an exceptionally cold winter in Asia, we would not have that buffer to keep the TTF under control. So that is the big risk of this winter. We're about 5 BCM down on last year's levels at the moment. We're going to be probably closing in about 85 BCM by the end of October.
The coming weeks are going to be crucial to give us an indication of what to expect in the winter, both in terms of Nord Stream 2 and also storage and supply from elsewhere. So, James, thanks very much for joining the Montel Weekly podcast.
Happy to be on it. Thank you.
So, listeners, you can now follow the podcast on our own Twitter account, aptly named the Montel Weekly Podcast. Please direct message any suggestions, questions, or, let us know if you think you have a good idea for a guest on the show. You can also send us an email to podcast@montelnews.com. Lastly, remember to keep up to date with all that's happening in energy markets on Montel News. You can subscribe on Apple Podcasts and Spotify or wherever you get your podcasts from. Thank you and goodbye.